Hi everybody, this is an in-depth review of my own trading results since the beginning of the day trading room. This is part 1 of a 2-part video series. In this video, I will break down my results with key performance metrics data. I will also show you how I use Monte Carlo simulation to do forward projection on my future performance. Part 2 will be about looking at the impact of individual components of my trade management rules to find out how effective or not effective they really are. First of all, everything that you see here is calculated after all trading costs such as commissions and overnight swaps are paid. In total, over the past 12 months, I have taken 54 trades on smaller time frames, mostly on 30 minutes chart. 5 of these were closed out at break-even, so I have excluded them from my analysis. Later on in part 2, I will reintroduce them into the calculation when I look at my trade management plan. I had 20 winners and 29 losers from the remainder 49 trades, giving me a win rate of 41%. Average winner size is 1.68%, while average loser size is 0.42%, which gives me an average reward to risk ratio of 4. This means that when averaging out over 49 trades, my wins are 4 times as big as my losses. This is a critical metric number to have because later on it will explain my profitability. Moving further down, we have some more useful information. Largest win was 4%, which only happened recently. It was the last trade I took before doing this analysis. Smallest win is 0.4%. Largest loss of 1.35% happened when a trade stop loss was filled with negative slippage. Even though I only risked 1% on that particular trade, it was closed out for more than that. This only happened once, so it is acceptable. Smallest loss was 0.16%. Maximum drawdown was 2.67%, which happened during the 8 trades losing streak. This is another key metric number which contributes to overall profitability. Recovery factor, which is a metric on reliability of a trading method, will also be discussed in details later in part 2. Moving on to the most important numbers, we have positive expectancy of 0.44 and overall gain of 21%. As you should all be aware of, expectancy is measuring long-term profitability. It needs to be bigger than 0, and the higher the number, the better. On to position sizing. Normal position size is 1% of account balance, and I can go as low as 0.5% if required for riskier trades. Part 2 video, I will show you the effect of position sizing on my results. Last but not least, we have some numbers for longest winning and longest losing streaks. As mentioned earlier, the account balance only went down by 2.67% during the 8 consecutive losses that I had to take. Losing streak is a part of trading, and often they can be longer than expected. My trade management plan is all about keeping maximum drawdown low during losing streak, and it has done its job very well. I will be discussing my performance in terms of percentages and reward to risk ratio instead of absolute dollar amount. This is because I make regular contributions to my trading account as part of the plan to grow my money. These amounts do not count towards my performance because they did not come from trading. It's important to mention that I am trading for growth, not income, which is why I do not take money out of my account on a regular basis. It might be hard to believe that a low win rate of 41% could result in 21% gain over the course of 49 trades, until you see the distributions of trades graph. This is all of my winners and losers put against each other. The green bars are winners and orange bars are losers. There are 20 green bars and 29 orange bars. Notice the average size of the wins compared to the losses. This is how it works with high reward to risk ratio. My trading plan has a target set at 2 times reward to risk, and recently I have added an option for 3 and 4 times reward to risk. The winners are not always the same size at 2% either. This is because I use half position size of 0.5% for trades that I see as highly risky from my analysis. I also have a small few winners as well. It's a mixed bag. Not every trade will turn out exactly as planned. Something that I have always been proud of the most is my trade management style, which is heavily focused on keeping losses small. This is something that I spend the most time working on, and it has been a feature of my trading plan for the past 5 years. I use a combination of early exit price level and a validation test at the close of each candle after my entry. This style of trade management really paid off during the 8 trades losing streak. 8 back-to-back losing trades only took my account's balance back 2.67%. And 2 trades later, I made it all back with a big winner. This is how I achieve long-term profitability. Now it's time to do Monte Carlo simulation on my results to find out what I can expect in the future. This is one of many reasons why I put all of my trades in a logbook. I'm going to copy over all the trade results and put it here. The purpose of this simulation is to observe many different combinations of my results to find out what the maximum drawdown could have been if the order of the trades were different. In other words, the destination is the same, but the journey will be different. The account balance and trade distribution graphs will change as I go through each iteration. There is a graphical glitch in the first bar of this graph. Sometimes it is white instead of orange. Regardless, down bars are losses and up bars are wins. As I go through each possible journey to the same destination, I am looking at large drawdowns. This simulation gives me an indication of what future maximum drawdowns I can expect if I continue to trade as I do now. If, in the future, I go through a drawdown much bigger than what was observed in the simulation, then I know that something is not right and I need to stop. This is what I call forward projection using statistics. It gives me peace of mind knowing where the limits are based on my strategy performance. As long as my results stay within the limit, there is nothing wrong to fix. This concludes part 1. See you in part 2 where I compare the effectiveness of 2 key components in my trade management.